All right, let's start putting our Ouija boards away and wrapping up the seances because Jerome Powell, chairman of the Federal Reserve, came out today after the Federal Open Market Committee and announced that the Federal Reserve will be raising the federal funds rate 25 basis points. A lot of uncertainty around this meeting involving the banking system, the overall economy. Are we going over a cliff? After just watching that at the press conference and taking a look at their press release and the summary of economic projections, Matt and I got a couple of comments on what this might mean for the economy and the multifamily industry. Underlining that we don't know. We don't know. A lot of other reports looking at the Federal Reserve, and I don't even know. I threw the sheet away, man. I don't know. Great episode. A lot of macro factors. Again, we've talked about every 2 weeks. Something's different. Something is exciting, and we're here to break it down to you how it relates to real estate. So welcome to the Gray Report. If you're a multifamily investor, active, passive, somewhere in the middle, this is the spot for you. We're breaking down all the latest data, research, throwing out some original opinions related to the multifamily industry, housing, commercial real estate, and the macro economy. Strap in. Let's get into it. All right, everyone. Welcome back to the Gray Report. I appreciate you taking the time out of your day to watch this YouTube show and podcast. You could be listening on the podcast. Joined once again by Matt Bosnagel, Director of Communications and Marketing here at Great Capital, co-host, producer of the Gray Report. Matt, got some stuff to talk about today.
Exactly. Yeah, I don't think we're out of the wake of financial crisis and
not out of the woods. No,
yeah.
Gotta get comfortable. I mean, if you haven't pitched the tent,
yeah, I know.
Gathered firewood, found your water source.
Yeah.
Started gathering, protein.
Put your ground cover down.
Ground cover first.
There's a storm.
Yeah, no, you got to position yourself right. Now, Matt, it's 1 week.
Mm-hmm.
Snip, snap, back and forth. And, is the economy going to crumble or not? I think you have to have a long-term view, be optimistic. Last week, though, we were talking about potential, structural issues, potential complete collapse of the banking system. Just listen to Jerome Powell. Now, we all remember transitory, so it's we're watching out for a don't cry wolf situation.
Mm-hmm.
At the same time, they're really trying to instill confidence in being consistent. And the biggest takeaway was the whole talk of the banking system was covered in less than 2 minutes. At the beginning, you mentioned it, didn't mention Silicon Valley Bank, didn't mention really any banks specifically until he got to the actual press conference. But it basically described, and I took notes, he basically described it as an episode, which I thought was and this was written out, and I thought episode was a unique word, the way to describe it as something that we're, that's relatively defined in time.
Yeah.
We're not talking about a saga. We're talking about
it's not a mini series.
It's not a mini. It's an episode of one through this process, and really moved on and made it very clear what the focus was. That is fighting inflation, not taking the eye off the ball. And if they would have not raised the Fed funds rate, which many people, of course, wanted them to not raise rates because it would have been good for their own pocketbook or their own investment book, the sign that would have shown was that we were in major trouble. Inflation was high, but the problem is so bad that we have to, hold off from our mandate. He reiterated multiple times, again, this is not even in the press conference, this is just in his written remarks, is that they are strongly committed to 2% inflation. And he said things like, long run inflation expectations remain well anchored, meaning we got to keep going. And if inflation is starting to, temper somewhat, and he doesn't think it's going to be right away, but we got to keep driving this thing home.
Yeah. The risk of going away, they still see that risk of inflation getting outside of their control rather than...
Yeah, I think that is a much bigger risk in their mind than the issues in the banking system right now.
It's funny because in the lead up to this federal interest rate increase, there were talks of not a dual mandate from the Fed, but, like a triple mandate. And as far as I know, financial crisis is not necessarily in their employment and inflation kind of dialectic.
Maximize employment and price stability.
Yeah.
No, it was not to maintain, to avoid recession. I mean, they're actively trying to create a recession right now.
Yeah.
And now there was another quote that basically said that, they're very aware that the impacts the Fed's decisions have on households and communities. Like, they're very aware of that, but looking at the broader goals over a longer period of time and seeing higher inflation over a long period of time being much more detrimental to households and communities rather than a relatively short-term bump up in unemployment, which their projections for median unemployment rate, their projection is for it to rise to 4.75% by the end of the year. Come down to 4.5 and come down to 4.5 by the end of 2024.
Well, can you pull that up?
Yeah, let's take a look. So we do have not only the press release, but we also have the summary of economic conditions here. Now, I think this is on GDP right here. Matt, but I don't know. Oh, we got unemployment right here. You had it right on the. Now, these are also obviously showing ranges, and I believe this is also this is the opinions. Yeah, this is the projections from all of the board members of the FOMC, and so you can see the median, the central tendency of the projections, and the range of projections. So, just we're talking about unemployment. They basically have it at really 2024 is the widest range. They have it ranging basically at the peak just above 5 all the way down to 4. So between 4 and 5. And then they have it, declining after that. But the current unemployment rate, right now is, what do they have it at? Is it 3 in the dot, 3.25 nationally, Matt?
It looks close to 4 maybe.
Kind of hard to see on that. I don't think that.
What's interesting also about this chart here, I mean, all of their projections, even the low end, are slightly above. We're going to end up slightly above where we are at now in terms of unemployment. Like, it's going to get, I think the unemployment is very tight right now. And I don't know do they have a percentage goal for unemployment like they do with inflation?
Yeah. So that's what I did. So the goal is, maximize employment. Employment. No, that's I think a little bit of a loaded term, but I think 5% is kind of typically an okay range.
And that's what I thought too, as a rule of thumb.
I think they'd like it to be they'd like it to be as low as possible without causing inflation.
Okay.
Is what they would really like to see. I think between 4 and 5 is typically pretty good, really good.
And the
10% it was.
That's true.
GFC. And
the maximum of even the most pessimistic projection in unemployment happens in 2024 at a little over 5. And so all in all, the unemployment should stay within normal range. Now, here's another thing about unemployment is it's a little bit of muddy waters right now. I'm not sure because of how all these hirings and firings are, and then you hear on one end, people looking for jobs, they can't find jobs. On the other end, you're hearing about people, jobs not getting filled. So
if anyone tells me that they're looking for a job and they can't find a job, but the tips typically it's you're looking for jobs that you are vastly unqualified for, or you're really not looking that hard. If you want a job, you can get it. It may not be your ideal job, but if you are someone who needs to make ends meet, there's some opportunities out there.
Yeah,
might not be doing what you want to do, but there's options. Looking at the dot plot, Matt, this is looking at the Fed funds rate. And this is each little dot represents the opinion of FOMC, Federal Open Market Committee board member. So they see we have 2023, where we're going to be at the end of 2023.
Okay.
It is now all above 5, folks. Only one member has it just below 5, but pretty much everyone is at 5. The highest dot, there is one dot just below 6%. Now, sorry, go ahead, Matt.
So the vast majority, the median for the peak of this year, would that be at 5 or 5.25?
I don't know exactly what the median is. I mean, the consensus here is everyone's got it just right above 5.
Okay.
So I guess right in the line is 5.25. So just below 5.25 is what they're saying. Now, after the end of this year, going to 2024, decent amount of consensus that the Fed funds rate will decline. But we've got a range all the way from just above 5.5 all the way down to just above 3.25%, with the most members having the Fed funds rate right above 4%. So that would be lower than things are today, because I think we're based on the 4.75 to 5% range.
Think about
right now.
I mean, the way they projected, it seems like we'll lose maybe 1% a year on the way down. We gained 4 or 5% on the way up.
Yep. And that's right in line with their projections for GDP as well, not to jump around, but the GDP projections at the end of this year. Sorry, no, we're talking about the same thing. The median Fed funds rate, 5.1 at the end of 2023, 4.1 the end of 2024, 3.1 the end of 2025. So they're just 100 basis points a year taking down in the Fed funds rate. And, there's a lot of correlations between inflation and rates, and maybe we'll see a similar type of reduction in inflation. I think that would be the idea. But, moving forward in their long run view, so this isn't necessarily 2026, which the year before that in 2025, the highest, there's a single dot, which is a couple hundred basis points away from the next highest, right above 5.5. But the rest, the next highest is just above 4.25, with the lowest being just above 2. So a wide range, with the majority being just right around that 3% range.
I'd love to be able to highlight these dots and know which one of these Fed members.
Well, sometimes you can, if you know the personalities or how hawkish or dovish. Like, I bet you could probably I'm not the one to ask, Matt, but I bet you could probably figure out.
Based on
this outlier of in 2025, who has it still at 5.5. But that shows. I mean, there's like a decent amount of consensus in the near term, but there are some. There's some folk. There's a wide range. 24, 25. Now there is more consensus over the long run. Pretty much everyone's at 2.5%. But you still have some, if you have 3 members that say that Fed funds is still going to be 3 to above 3.5. So that shows that, one, that we don't know. 2, it's going to take longer than would be ideal.
Can we check out the GDP? I think it's a little bit before the top plot.
Well, yeah, I think we had just skipped over it. Yeah. Changes in real GDP. So they're projecting essentially, Matt, is a kind of a slight tick up of GDP, but to be relatively sluggish. Really, but this year it's between 0 and 1% ish, and then it's going to rise slightly to be also maybe just a couple basis points to being 1.5%. In 2025, they're thinking it's going to be a 2, and that is, we'd really like to see GDP between 3%. If you got inflation closer to 2%, this is still, I'm describing a scenario where inflation is running hotter than GDP, and we may have a little bit of a stagflationary situation, especially if unemployment rises. The one thing that stagflation isn't a pure. There's no pure definition. It was something that was made up in the 70s. We've talked about high inflation, lower growth, or high unemployment. We don't have the high unemployment, but we certainly will have high inflation and low growth. And frankly, we are experiencing that today.
And that's the biggest gap, or the biggest area of uncertainty, seems like their projections for the unemployment rate this year among all the different ones. But I guess the outliers, the central tendency of projections is the largest when it comes to that.
No, and so the big question, Matt, is has the Fed instilled enough confidence in the market with this 25 basis point increase, and what they've said in the press conference, that we're through this episode and we got to get on to fighting inflation. The economy is actually in a good spot. It's running hot, and unemployment is low, and maybe some of the tightening that needs to happen, the banks and the other credit facilities are doing that on their own with all of this, and they mentioned that a couple times.
That's
but so is this Are the fears of investors in the markets, are they quelled by this, or is it? I can tell you with a couple of conversations I had immediately after.
I do not think. No. So I think that on the one hand, it is an expected. I think the best Fed move is always the one that everyone sees coming, and it's the one that they've telegraphed beforehand. Otherwise, they're not really doing a great job of communicating. Most of the projections were 0.25%, but there's an argument to be made that, man, if the longer things remain this high, considering the conditions, we could have another crisis on their hands. And I think they have made clear that they're not really interested in making sure that it's a crisis-free environment. That could be if we have these sporadic crises here and there, a bank failure or whatever failure here, and then that may get us in the aggregate to just the amount of pain that the Fed needs to see.
Well, I do feel like, the whole idea was we got to cause some pain, we got to break some things, and now and we've talked about this, but like now some things have broken, seemingly, literally. I mean, between Silicon Valley Bank, Signature Bank. I mean, First Republic is tanking. Credit Suisse obviously failing. So some things have broken.
Yeah.
Now, if there was anything that's going to break, maybe these are the entities that are fine breaking. I don't know. I'm sure for some folks it's not great, but we're seeing some actual, seeing some. We've had the cause now. We're seeing some effect, but is it enough?
Yeah, and so that's all. I don't have that much confidence in this perspective specifically. I think it's definitely, it's not an emergency, but I think that the idea that there is this pressure building and there's some cracks and there's some, we saw a little bit of a crisis here, but are we going to look at the places where the places that are going to give under the pressure, or do we eliminate the pressure itself? Because it could just be systemic. I don't know if there's going to be 5 large events in the next 5 weeks, or are they going to happen at the same time? And so maybe instead of trying to guess at where the next hole in the dike is, maybe we just, try to really, hold back the ocean.
Well, I think that's.
I think that seems.
I think that's what they tried to do, and he outlined a couple of things that they've done over the last week or so. And so I heard him say all depositors are secure, and it seemed to say, because the controversy is, okay, you're implying that depositors are secure across all banks, but technically it's only been for these handful of regional banks that have gone for this emergency assistance.
Yeah.
But so those folks deposits are secure, but everyone else's aren't. Jay Powell, who doesn't run the FDIC by any means, but he seemed to say that all depositors are secure. And I want to look into see that was that just talking about at those banks or in general, because they kind of communicated, they, not just the Federal Reserve, but other institutions, Treasury, FDIC have somewhat kind of communicated that's going to be the case. The bank has to go and ask for special circumstances, but seem to be getting it. The next thing, Matt, is the issue was the debt value of the bonds all screwed up.
Yeah,
with the yields coming in the past since all this happened. The Treasury 10-year was at 4, now it's at less than 3.5. The value of those bonds have actually increased quite a bit, and so they're not in as dire straits as they were, week and a half ago.
Yeah.
They're also, they have this new facility that, many would call a bailout of the banks, that banks can now sell their bonds back at par.
Yeah.
So basically, they could have devalued significantly, but they can kind of turn them in at par, almost like that they have reached maturity. That seemed to be the big thing that was really the systemic structural issue. They can just print money. We've seen that they've actually increased the balance sheet. It's supposed to be tightening. They've actually increased the balance sheet. They were selling off the balance sheet, reducing the balance sheet. They've done the opposite recently.
Yep.
So it's not really quantitative tightening because they're not really trying to increase the money supply, or quantitative easing because they're not trying to increase the money supply. But they're basically saving these banks that no one would say that these were risky investments.
Yeah,
they were. You could say that there was inadequate rate management and risk management of these assets. But they're basically saying all is good. We can't have the banking system fail right now. And
it's I think that's a Band-Aid mentality. I think that the same thinking is okay, we found this problem, we fixed this problem, we're good. But the solution may be different for different times, and it's certainly not applicable across the whole entire system. Otherwise, you have to, if all money is guaranteed, even beyond a certain limit, if people get to cash in their bonds whenever times are bad, does that not encourage bad behavior? I think
exactly. In the moral hazard is what we're talking about.
Exactly.
It's the moral hazard of letting people making bad decisions in a capitalist system. They should have to eat those consequences. That's how it works.
Yeah.
Without that, the system isn't efficient, And you can't, again, like I said this last week, you can't have the winners without the losers. You have to have some things fail for some things to grow. I mean, the freaking forest has to burn down for the new growth to emerge. I mean, you have to have this in all like natural like systems. And that's what an economy is.
And that's true. They're looking at one tree burning, and they're not looking at the whole forest that's smoldering. It's a forest and tree situation.
Yeah, they're trying to do a controlled burn.
Yeah, I know.
They're trying for the controlled burn, but it's
and I was thinking about this too, and trying. Everyone's assigning blame. Did the Fed not regulate enough? Did they not? Are they going too easy on it now? And I think that's. When you look at it relative to interest rates, it's like they created this situation, and to be aware that it's interest rates that are really driving this is also maybe to prepare yourself for the eventuality that something similar to this might happen as long as rates stay increased. And I think that the other excuse maybe it was the banks that made bad bond decisions, whatever, or it was the bank run that a couple.
Well,
people,
that's really what did in psychology.
So here's the psychology. They sensed vulnerability for a good reason. At first I was like, well, they just got crazy one night and they were too scared. They didn't need their money, but they sensed vulnerability for good reason because the rates were high and they were already doing a little bit of firing on their own. They saw the tightness.
Yeah. And one thing, I do think you're right that like, I don't think this is the last of it. There's going to be other issues. I don't think we know what they are. Maybe they're not as big. Maybe it's so much worse. One thing I do know is that every business and individual, I think, has kind of rethought their relationship with their banking institution. Yeah. And I think we're going to continue to see outflows of deposits, in and out of banks into different products, whether that's into treasuries. I think a lot of people are like, oh, I just need to buy treasuries right now, or I need to get into a money market fund. I need to get some yield, especially if you're a business and cash management. Treasury management hasn't been the top of the priority because in the past 10 years or so, you weren't earning any interest. So you were going to, and I was having a conversation with someone yesterday about this or a couple of days ago, and it was related to like reserves for like a multifamily investment, cash reserves, not the ones that your bank holds in escrow, but like cash in the bank.
Yeah.
And in the past, you could jump through some hoops to earn some marginal return, but I guess our perception was for earning hardly anything at all. We're jumping through some hoops. Let's keep it simple. Yeah, we're not going to earn anything material on the interest, and let's not try to financially engineer something to get a return that would be meaningful. You'd really have to take on risk that would be inappropriate for those types of funds. And like buy a treasury and yield, at the time and yield, nothing. What's the point? But now all of a sudden, you're looking at, when we look at our portfolio, in each property having reserves, you start adding that up and it's hundreds of thousands of dollars, millions of dollars, depending on how much, cash you have in reserve. If you can get 4 to 5%, cash yield versus 0%. I mean, the big bank we're at, which previously we were like, we really need to maybe look at maybe a smaller bank because there's fees and stuff and we're earning no interest, whatever. In fact, with the fees, it's actually negative interest. Yeah. And the banker, I'm like, well, why aren't your, deposit rates increasing? Well, basically we don't have to because we're a big bank. Yeah. So I'm like, what's the point? But then all of a sudden this happened and I'm like, oh wow, I'm actually really glad that we're at a big bank. I'm not, and maybe it's a false sense of security, but I'm not as worried being at basically the biggest bank in at least in the world. I
wonder if, some of these regional banks may fail. There may be like a greater consolidation among the regional banks. And instead of maybe all pouring into one, for the ones that are operating well and making good decisions, you'd think that they could take advantage of. But
I think you're right, and we know a bank in our backyard, and I haven't looked at their ticker recently. Merchants Capital is doing really well. They do a lot of multifamily business, but they've got a lot of products that are kind of perfect for this environment, and seemingly do really well. But as we said, next week, no one likes getting calls and messages from your bank or banker having to reassure you that everything is good and solvent. Yeah. It's not a good feeling. For me, it causes a little bit more alarm. And
I liked your quote from a couple weeks ago in your interview with Paul Bergeron. You said Biden said the banking system was okay 3 times, and every time he said it, it didn't
I know
sounded worse.
Well, and so like we haven't, and maybe we should, Matt. I don't know. Leave in the comments if you agree or disagree. We haven't issued necessarily a statement to investors from Great Capital on SBV. Now we've come out. This is our 3rd time. Speaking on the Gray Report. Now that doesn't go to all, our investors don't all watch this by any means, but if we report regularly to our investors, and we are on. There's like I had an email asking what our exposure was to SBV. We have no relation, completely unrelated. I hadn't really heard of them. Maybe I had heard, not really familiar. No real exposure. Most of our debt is fixed. Our reserves are held at a major banking institution. All is good. But behind the scenes, we are definitely making some moves and re-examining all of our banking relationships and how do we get appropriate yield and making sure. I mean, to be honest, always aware of the $250,000 FDIC limit. But frankly, we have plenty of accounts that had more than $250,000 in, and you can look at us now and say, "Yo, you're an idiot. That was uninsured. That was so risky." No one. I think it's such in retrospect. Monday night quarterbacking. And I even think that the SBV stuff. I think a lot of the decisions they made. I mean, some probably bad investment decisions were made, but I think that there's a lot of commentary of that is just Monday night quarterbacking. And this is just. And again, there probably some mistakes were made, but I think there's a lot of things that happened also that were like, I don't think anyone really predicted this was going to happen.
But again, it's like you were creating this environment. It began with the feeling of risk among those VCs that decided to do that bank run.
Yeah, and exactly, it wasn't really the systemic. It wasn't the systemic problem. Wasn't the balance sheet that was a problem, but it was the bank run and the fear.
And I think that fear was legitimate, or at least
it was.
Yeah. I mean,
well, it can you can manifest a lot of things.
Yeah.
Especially a large group of people with a lot of money. It can. You can.
Yeah, because they thought maybe just like the pressure that they're feeling on techs or on their own company, whatever tech things they have invested in, then there could be less deposit, or the depositors are going to want out. Because of their own personal business failures, not because of a bank run, and that probability reached high enough where they're like, okay, this could be serious. People could be running.
No, I mean there were wealth managers were calling their clients last week and acting as therapists, just talking to them, strategizing, recommending, looking at money market accounts, moving out of certain banks. That there's a lot of money being moved around. Now it sounds like a lot. I mean, Jerome Powell made a comment at some point, basically saying that the withdrawals have slowed down significantly. But man, last week and early this week, I know people are making moves, and sometimes that can't happen overnight. Sometimes it can. But it's going to be interesting over the next couple weeks whether there's another shoe to drop in this specific story in episode 2, or if we are on to the next episode, something different. All right, Matt. Let's talk about multifamily. RealPage, best and worst performing submarkets since the pandemic. I'm interested. I haven't looked at this yet, so you're gonna have to tell me.
What are the best? Kind of to switch gears. This report was really interesting. Not really as a snapshot of the current market, but really as a reminder of the extreme amount of growth we've seen in many apartment submarkets since the pandemic. We're talking about 3 years of growth. So the average annual growth numbers are going to be a little less than a third of the size of the total figures for the 3 years. But regardless, you get a size. If looking at the best performing markets, you get a size of the magnitude of growth that we saw in the years between 2020 and mid 2022. And well, up till now, really. But what really is the dominant period is that year and a half between like late 2020, mid 2022. You get an idea of how much some markets also can leap ahead of the performance numbers for their market and for obviously national average. The range of these is for the top ones is like 39.2% for the top end. And that is Pinal in Texas. Pinal? Wow. Pinal.
Penal.
Yes, and I'm sure it's a Phoenix submarket, and then there is a Pembroke Pines Miramar. I'm gonna get into more comfortable territory here, in Fort Lauderdale. In terms of geography, all of these are Sunbelt. You've got Atlanta, Tampa, West Palm Beach, Charlotte, along with Phoenix and Fort Lauderdale that I just mentioned. Not all these markets are on the top of the rent growth charts right now, especially in Phoenix.
Yeah.
But again, even with a quarter or two of sometimes negative rent growth or zero rent growth, there's not much of a dent in the rent growth of these Sunbelt markets over 3 years. And like I said, you divide this by 3 or 3.5 or whatever, and 39.2, that's like 10% a year, or maybe 12 or
which is basically 3.3 years of rent growth in a year.
Yeah. So, and I think that this is also a perfect illustration. Like the Phoenix numbers, maybe not 39.2%, but there could be a neighborhood, a area of town that really rockets up.
Yeah.
And if you look at the lowest numbers, it's clear, you see the same drama of the either climbs or stagnation. The same period of time dominated the low end, because you see San Francisco, New York, San Jose, Seattle. These were the expensive places to live.
Yeah.
The people said, oh, they're moving out. So downtown San Francisco still kind of catching up, but New York and Seattle and San Jose too. San Jose is actually doing really well. It's recovering now. And so to a certain extent in San Francisco, but total, they still have not gotten back to where they used to be. And the top fall, so downtown San Francisco is still, for these 3 years up to now, negative 11.1 or 11.4%. So yeah, still dramatic.
We saw there's a lot of divergence in these submarkets, as you said, like Tampa, high, now it's down. Phoenix, same thing, way down. New York City, down, but up. San Francisco, down, still kind of down. Minneapolis, down, still kind of down.
Yeah, so that's true. There are definitely ways to kind of characterize each of these, and we're catching them on different patterns. But it does seem like and it totally makes sense that the inflection point happened really like during 2021, like that.
Oh yeah.
Months surrounding that full year was more happened in the movement of apartment markets than the height of the drama of the pandemic or the really start of the recovery kind of.
The way we described it at the time, and go back and watch the Great Report episodes, because again, every week we were doing this during the well, at least a little bit into the pandemic, but the way we described it is the ground was moving beneath our feet so quickly. We could feel the gravitational pull of the economic activity and rent growth, whatever you want to call it. And we were talking about it, we were experiencing it every week, and it was insane. A lot of people didn't believe us. We were coming out with deals, and we were tracking the data on a day-to-day basis, and we're like, this is happening, and they just were in disbelief. And then at some point we're like, it's not happening anymore. Halfway through last year, the party was over.
And I think that there is a benefit then in these volatile times. You look for stability, and I still think there's a little bit of a snapback, a little bit of a reaction, I think, and that kind of leads us to this next article about the rents are rising fastest in the cheapest real estate markets. The places with lower cost of living are the ones where rents are growing faster, and I don't think that it's entirely because a bunch of people are suddenly moving to these locations. It doesn't necessarily work that way, but it does mean that there is more room for them to grow. And
do you want to schedule a tour with Nedlon?
Yeah, the picture here includes a useful phone number for us to call, and maybe we'll get an apartment available, or maybe we'll figure out the price.
I'm always curious. I'm always curious, and I saw a guy do this, and I was like, that's. You just shop. I mean, you can do shop apartments all the time. I'll shop apartments, but like he's just calling every number he got just to see the response was, and he was like a lease trainer.
Yeah.
But let's I know that we're diverging a little bit here,
we'll
man.
See.
We can always cut this out if it's no fun.
Thank you for calling Madeline Management. Please listen carefully as our menu options have changed. To speak with a leasing professional, please press 1. For maintenance, please press 2. If the property owner,
Where do you think this is? 786, ComTrues.
is made easier with that.
What do you think about this system? I would love to talk to a person.
Yeah. I'll give you to a person quickly. That's still something that.
So, I'd recommend having at least someone answer the phone. Anyway, Matt, after, that was fun. But cheapest rental markets are not as cheap as they were. Still cheap than the rest of the nation, but this is affecting, markets in like the Midwest, some markets in the South, and some other rural markets. People are flocking towards affordability. And again, we've seen that in the Midwest, whether that's Indianapolis, Kansas City, Cincinnati, doing incredibly well.
And so they're looking at these markets, and like I've said before, just a few minutes ago, the variations about market numbers are going to be where a lot of these different reports from, whether it's Realtor.com, RealPage, or Apartment List, or Yardi Matrix, whatever. But when you see a pattern in these markets that are getting a really high rent growth, then you feel a little bit more confident about what kind of trends and which markets are performing well.
Can I tell a couple anecdotes about the rent growth market and traffic and activity?
Oh, totally.
Because we're looking at the data on the national sense. I find it incredible how, not always, but often, the national data can correspond to actually what's going on, or just seeing what the difference if there's a lag. And a lot of times I see in the data before I actually see it, and all of a sudden, then it's like, and I guess there could be some confirmation bias there too. But still, growth is growth. Loss is loss. We're seeing more traffic. Last week, gangbuster week for traffic, gangbuster week for leases. Across the portfolio, talking to other apartment owners. Now, asterisk, I'm talking about the Midwest, really. Now, I need to reach out to some folks outside of the Midwest, but...
How do you track the traffic that you get? Do leasing agents, they log each call and...
Well, they better be.
All right. Yeah.
They better. Yeah. So, I mean, and a piece of traffic could be anything from, an inquiry online, not that big of a deal. Could be someone stopping by the apartment community. Then it could be a full-on tour. And then, you have your, actual tours given, and then, applications that are submitted, and your net leases signed. Some are approved, some are denied. But we're probably an 8-week high of traffic, leases signed. We, from some apartment communities where we had actually dialed back the rent after we were able to get some really high rents, and then all of a sudden traffic slowed down, and we kind of dialed it back down. We've dialed it back up on a handful of floor plans at specific properties. So we're seeing some positive signs, a little bit of green shoots. And about a month ago, 3 weeks ago, a month ago, we started seeing some signs in the data, Matt, that was pointing to, there wasn't enough data, but again, a couple of green shoots. Yeah. And so far, the frost has not killed the green shoots. Yeah.
It seems like we're tilting upward in terms of rent growth.
Not enough data. And again, our big recession, the economy collapsing in the bank system, that's not going to help.
Yeah, I know we spent a lot of time talking about the Federal Reserve and interest rates, but it is no more relevant to the multifamily market than it is now. Now, I would say it's great to have a kind of sanctuary from greater economic volatility when it comes to multifamily investment assets.
Yeah, relative.
But it is. But these are times where there could be some very far-ranging effects in the economy in general, and so.
Yeah, and I was thinking about this earlier today. I think it's going to be so interesting about how. These changes in macroeconomics. The whole point is them to change the economy in some way, but you can feel them sometimes. Sometimes there can be, people say, 6 to 18 month lag, but you start feeling some of the effects that are, again, like uncertainty about the economy translates to sentiment of negative sentiment of all kinds, which translates to people not renting apartments because they're not sure.
So, and that's where I wonder. So. Back to kind of this idea that rents are rising faster in the cheaper rental or cheaper real estate markets is, if you're going to see rent growth, maybe it is more likely that you'll see it in the cheaper areas. They have more room to grow. And if there is any pressure, that's the place where it's kind of going to be relieved first at the expense of these hot markets that were growing, like we saw, like 39% in the last 3 years. Yeah. And that's probably not the most they've ever grown. They probably, spent the last 3 months with negative rent growth. Yeah. But there does seem to be such a snapback in all these other markets. And the cheap ones maybe are the stable ones.
Often, there. Not always. Sometimes you get what you pay for, and it can be too cheap. But there's a difference between cheap and value. I don't know.
Yeah, but the specifics. No, you're right. I think that a place like a place like Minneapolis has a very different rent growth situation than Indianapolis. Indianapolis is at now we've heard other reports with different numbers, but Realtor.com has them at 11.8% year-over-year rent growth compared to the 3.1 for the national average. Oklahoma City and Birmingham also rank up there for rent growth, but it's because I think the cost of living, it's low compared to other markets.
But what's interesting about Indianapolis is that it's not like we saw a rent decline during the pandemic or like those markets. We had solid rent growth. There were some markets that really eclipsed us at a certain point. They were growing high. Now we had some markets that were right up there with them.
Yeah.
But we just never seen the declines. It's still on top.
Yeah, and so
I'm sorry, that's some strength.
Yeah. Well, it's like I wonder how much you lose by opening yourself up to that volatility of the Sunbelt market to go up and then go down a little. Whereas at the very least, and I said this probably exactly last week, you get more predictability that's easy for you to not fall on the wrong side of something.
I see. The potential. I don't see the downside. I don't Indianapolis isn't turning into a Phoenix anytime soon. Just we're not in the Sun Belt. We're not going to get all of a sudden random mass droves of immigration. Now we grow more than percentage point a year, solid job growth, population growth, but it's not like Phoenix, which is stable. You don't get the big swings up and down. But if we became super high population growth metro, fine. Yeah, I'd take it. It
introduces new uncertainty though, because then you have the supply. Like, are they going to respond with too much supply? Are they going to hit at the figures? Or
that's exactly what would happen. And that could be look, I'll play devil's advocate for Indy. You may see some maybe more supply coming to Indy over the next couple of years. And now we do need a lot of supply, but maybe it'll tamper down things, and we'll see rent really flatten, plateau. Maybe even some declines in the next couple of years. We shall see. Well, we've got one other report, Matt, today. It's an IPA report.
Yeah, really.
Special report.
You can read this special report. It's a couple pages. It's got a couple graphs that you just glimpse at them. You don't need to really.
Don't need to actually read it.
Don't really need. Well, if you want to, it does have a little bit of pull out kind of examples of some things, and some kind of like speculating. But I really liked it because it shows the gap between mortgage payments and apartment rents, and you can track how this gap at the start of early 2022, when rents started to kind of slow down and moderate, the mortgage payment growth was incredible, and then so that kind of creates the situation where these millennials, the millennial generation who should be buying homes, they're continuing to rent, or at least there's becoming a very good reason to continue renting, because it's not necessarily because of home prices, but it is creating
interest rates. I mean,
it's interest rates.
I was talking to Glenn, and he was like, okay, this house I was looking at, he's like, the price has gone down. He's like, I've been following. The price is down 16%. The mortgage that I would have paid last year was about $1,200 a month. The mortgage today is about $2,300. And he's like, wow, so it's like
double.
It's double. Even the price has gone down.
Yeah. So, and that's the missing element.
It don't work. Math doesn't work.
So no one wants to sell because they'll then have to rebuy it at high interest rates, or they just can't deal with the idea that they've got to come down in price for it to be the most nearest model.
Yeah, you'd have to be so non-affected by price. Yeah. To say like, okay, let's get a house half the size, or we're gonna get the same house basically, maybe not as nice, and pay double. And
I forget if I was talking to you earlier in the show or before the show, but I think that it's like this pent-up demand, or not really pent-up demand, but we've got a group of people that if interest rates weren't out of whack, they would have sold their house, whether they wanted to or they needed to. Yeah, that desire would have been met if everything else was equal. But because interest rates are high, now they couldn't do what they wanted to do. And does that have? And then when they finally have to, what's the cost of that? Yeah, what is it? And it's someone's needs or desires aren't being met. And in perfect economy, it would, but now we have that barrier. There's got to be, it's not just you snap your fingers, buyers and sellers finally meet. It's like, no, someone's going to take a bath. What is that the term?
Yeah.
Someone's someone's not gonna get out of this very in a good place.
Yeah. Again, yeah. If you're locked in at 2.5%, 3%, 4%, I mean, it would take a lot. Now, what's being missed? And yeah, there's some maybe we can't move to that slightly bigger house when we wanted to. I think people can overall, live with that. But think about it's a lack of economic activity, the slower velocity of money. Think about all the construction projects that aren't going to get done. Someone's not moving in. They're not renovating that home. Now, maybe they spend the money on renovating the home instead of moving.
Yeah.
But it's not the same amount of construction demand than building new single family homes, because there's a bunch of demand for it because people are able to even buy those homes.
Yeah.
So and then folks trying to buy it's just not. It may no longer be an option. It may have been a stretch before, and now it's no longer an option.
And that's what I wanted to add before we wrap this up. They do explain in the report. Maybe they give like examples of some of some kinds of people that want to buy, but they just can't buy, and they're all going to flood into the renters market. This is a more convincing story of people deciding to rent over buying than we were making 2 years ago or 3 years ago. It's funny. It's funny to think about that, because we were making this very same argument when interest rates were.
Yeah, it was a better deal to rent or buy. And then we looked at a graph. I forget who put it out. Maybe it was Marcus Millichap. There's a period. Where it kind of made more sense to buy.
Yeah.
And apartments did really well. Solid rent growth, solid performance. But the case, if you just look at what people can afford and the options that people have or don't have, we're going to see, unless people just decide to all move in together and move in with their parents, we're going to see some more demand in the rental space. And I'd love to see it quantified down to, for every year this median age of first home purchase gets pushed out. Right now it's basically 33. For every year that gets pushed out, how many million units of demand that is.
Yeah. And another thing I'd like to know too is
absorption.
Is absorption, and how much household growth or household formation is there going to be? Because if it's even household formation, then all those would-be home buyers do become renters. But if it actually makes a significant dent in the household formation, then we might be able to measure actually how much of a chunk of would-be home buyers apartment renters become, just by triangulating there.
Here's my gut. A lot of these folks, they're probably going to be looking at, not all, but Class A, luxury.
Yeah.
If you were someone that was on the fence of whether you could, buy, you're at the stage of your life where your job is, decent enough, you got a decent enough income that you can think about buying a house, probably should be able to afford a luxury apartment, you'd think.
Yeah.
When some going from, C class to
it's the same price range for sure.
But and so there's all this new supply of A class properties. This may be a little bit of silver lining of that, because that new supply may be absorbed relatively efficiently over the next couple of years. Is my perception, again, it's a anecdote, just my perception of millennials that are 33. I'm 35, so I've got a little bit of insight. A couple that's 33 and has gotten married, they're going to want something a little bougie, a little not, little nice. Maybe there's certainly those super thrifty. Let's find the cheapest place. But I mean, if you were thinking you were going to get a home, well, damn, I should at least want a granite countertop and stainless steel appliances and a nice pool.
Yeah.
If I'm going to be renting, I want to rent a nice place.
Yeah.
I don't know. Maybe that's an overgeneralization, but I think that demographic that's missing out on buying a home is going to go the bougie route.
Which
is a fine route for owners of A-class apartments.
I haven't, people talk a lot about build to rent. I think a lot of people will go to build to rent. I think that people want to
100%.
stay at home. They will stay at home.
This is totally the thesis argument for BTR, build to rent.
Yeah,
100% agree.
So that it'll be. I can't imagine this, and this is just the last straw, or this is just one more a pile of evidence that is pointing to increased demand if you're talking about a share of house.
I mean, Matt, how many people in our office are mid 30s, and if they don't own a home, handful of people own I think probably, I don't know, generalization, probably 50% of people own a home, and 40% are actively seeking to purchase a home, and 10% are on the fence whether they want to buy a home, probably will, but not actively looking.
Yeah.
And so the desire's there. But I mean, again, I'm going to go back to the conversation I had with Blend. He's like, I'm renting for the next couple of years. Why would I do that? That makes no sense. I'm going to rent for the next couple of years. He's like, I got a good deal. He's like, I got a great deal.
Yeah.
Like, I'm going to keep riding that deal until I can, until all of a sudden rates come down. I don't have a good deal, and on my apartment, I'll look for something else.
That
makes sense.
Looking at those lines, the such divergent line of the mortgage rate price going sky high versus rents predictably going pretty much the same rate as it's gone. And I think what's going to happen probably first is the home prices are going to go down.
Yeah.
And because of this situation where
it has to. Then I mean, numbers don't lie.
People are going to be now. It will get to a point where so many people have to sell.
The only saving grace is just still low inventory.
Yeah.
There's not a lot. Like if you want to buy a home in kind of Midtown Indianapolis, like not a lot on. Like there's a couple on the market at any given time.
Yeah.
Not a lot. Matt, what do you think this will? Long term effects. Do you think there's going to be like a wealth gap between millennials? Whatever, plus or minus, those who were able to purchase a home, and those who now are unable to, because it's like it was an option. There was an option for most, like when rates were basically zero, and you could lock it. If you could buy a home at 2.5%, if you were really scrappy, went after an FHA loan, 3.5% down. Not everyone has parents that can ask for a loan or something, but if you were responsible enough to probably purchase a home, you probably could have figured that out. Maybe
let's say
I don't want to say
okay,
that doesn't matter, but people did and people didn't. What's the effect over the long term?
Yeah. I think that a lot of people don't really, you think a house as investment or whatever. People can't really conceive of another place to put their monay. Like renting is just a whole different kind of financial lifestyle for an individual, and that's hard to not imagine as to work yourself towards. But I also think that a lot of this could be have to do with home builders. If they're not building new homes because they don't want to have to sell it for cheap, then it could mean that that someone that got a loan in 2019 is better off than someone now. But if it's just, high interest rates versus low interest rates, we got a big benefit. And now they have to pay for it because I don't think that prices are going to go below where anyone bought.
Yeah, well, I'm assuming that the purchase of a home is going to lead to wealth creation over time, or a different mindset of, how one, kind of manages their finance, because, having a renting mentality. And now I think renting can be a great tool to build wealth, and it can be a great tactic to be like, hey, no, I'm not going to invest in a single family home. I've got some money, but I'm going to put it in, Great Capital's latest apartment syndication because I'm a accredited investor, not an offer to invest or put in the stock market, wherever, but I have a better investment opportunity that I'm going to use this money for and grow wealth that way rather than investing in a single family home. Yeah. Makes very savvy. And I think that, I think most people, especially in the apartment world too, like a lot of these us owners are like, well, we own our homes, but maybe if I was not married and had kids, probably might rent something. I don't. It's a lifestyle choice. It's not. It becomes less of an investment decision. But you can't get around that. You're making a major investment decision when you're looking at buying a home. It's your single largest investment, especially at that age.
Well, and even what I always think of the very, very, very wealthy probably buy their homes. They probably spend less amount than anyone in that home. Yeah, but it's this. But they could rent. There are huge wealthy rental properties, but it's hard to get that. Even if you have the greatest of facility.
Oh man, yeah.
You want your own place.
My dad lives in Florida. My dad lives in Key West. He's got a home in Carmel, Indiana, and I've tried to convince him to sell that house in Carmel and downsize. Get a condo or something, rent an apartment. Yeah, have a home base in Indy, but you live down in Florida, so that's you don't need this house that would basically get together for holidays.
But
to him, it's home.
Yeah, so. Exactly. There is. So you're getting that emotional premium that was there in 2019, and now, man, it's even bigger.
Yeah. Anyway, it's fascinating, Matt. I think we're going to have a completely different narrative next week on the Great Report. Oh yeah, and I'm glad we waited to after the FOMC press release and presser. A little bit more context. So we'll get this out to the masses.
Oh yeah, let's do it.
Make sure. Well, first off, thank you. We really appreciate you taking the time to watch the Gray Report. Any insights, comments, if you can take the time, hit the like button, subscribe so you can get these actually updated. There's a little bell icon. Click that, and then you actually get a notification. If not, I get that too. But if you don't want the new data and research and analysis, then I respect. For those of you who do, leave a comment though. I'd love to hear your thoughts on the FOMC's decision to raise interest rates, the Fed funds rate by 25 basis points, basically saying that this whole banking contagion is under control. It's just transitory, Matt. It's fine. Don't worry about it. This is an episode. Is that a bunch of malarkey, or is it, we're talking real talk, sticking to the knitting. They're going to figure it out. Hopefully optimistic. I really am. As someone who is relatively skeptical of, big government, the Federal Reserve, a lot of times I'm like, no, I think this guy's smart. I think he's smart. He's trying to do the right thing here. But I think that's the fallacy is there's no right thing. There's no one thing. There's no one group that can make all the decisions for everybody.
Yeah.
But I don't know. It's what we got. So we got to deal with it and make it work.
That's right.
Next week in the Gray Report, all kinds of great stuff.
I know.
Matt,
something big's going to happen.
Something big. Do you know?
I don't even know about it yet, but I know it's going to be big.
It's going to be earth-shattering.
And like we say to our intern, if something big doesn't happen, make it happen.
Yeah. Oh, yeah. That's what we,
yeah.
That's what we say to George.
That's what we say to George. Okay.
Good stuff. Hey, yeah, we have an internship program here at Gray Capital.
That's right.
Get in touch with Matt.
All right, next week.
No, just contacts on our website.
Yeah.
All right, everyone. Thank you for watching the Gray Report. If you want to learn about what we do here over at Gray Capital, I don't mention this. I mention what Gray Capital does sometimes, but I only mention like what I do. But I don't really care that much. But Gray Capital, we buy apartments, we operate apartments. We're typically long-term holders. We're in Indianapolis, Indiana, mostly investing in the Midwest, investing for cash flow. We can only work with accredited investors, unfortunately, per the SEC, on high, that we have to follow whatever they say. So if you're a accredited investor, we'd love to have a conversation with you. Obviously, none of this is investing advice, just some fun entertainment, real estate talk and discussion. It's going to be an interesting couple of weeks, Matt. Interesting year, to say the least.
I can't wait for the next huge thing to happen next week.
Tomorrow.
Tune in because it's going to be huge. I don't even know what it's going to be. It's going to be huge.
Yep. And we'll be here every week.
That's right.
To break it down. And I didn't mention, there's a newsletter, way more information. Check it out. All right. See you next week on The Gray Report.